Next, we have cost volume profit analysis, CVP analysis. It is also called break-even analysis. It's a tool we have for understanding the interaction between revenues, fixed costs, and variable cost. We'll discuss what they are, fixed cost, variable cost. So, why is it important? Why is it important for management accountants to study CVP analysis, or managers to understand the idea of CVP analysis? CVP analysis allows managers to understand the probable effects on changes in sales volume, how the sales volume change affects your profitability, how the change in selling price affects profitability, and if you are selling more than one product like product ABC, if we change the composition or the mix percentage, let's say we sell 50% of A every year, 30% B and 20% C. So if we change this proportion, this product mix, also called sales mix, how would it affect our profitability? It's a very important area to be discussed and understood in detail. Learning outcomes. To understand the relationship between changes in activity, that's volume, changes in cost, fixed and variable, and revenue. Remember, fixed cost is a cost that doesn't change with the level of activity. Produce more or less, sell more or less, fixed cost stays the same. Variable cost, on the other hand, depends upon the level of production, level of sales. It varies in line with the changes in production and sales. Next, to appreciate the key assumptions and limitations of cost volume profit analysis. Okay, this CVP analysis, basically it's the domain of management accountants. We already know the difference between management and financial accounting. Let us discuss this briefly. It says financial accounting follows rules, accounting standards, IFRS. Management accounting doesn't follow any rule. You can use management accounting in any way you want, so there are no hard and fast rule like financial accounting. Financial accounting has historical perspective. What has happened, that is the focus of financial accounting, to be reported what has happened over the last period. Whereas management accounting is future oriented. This is the key point we are discussing here. Management accounting is future oriented and it provides information to managers, the decision makers, with which they can make decisions for the future. So this is what we say when the management accounting has a future orientation, because it provides information which will be used to make decisions for the future. Whether to make a product A or B, should we close a certain department X or Y, which geographical region should we enter, which new product should we launch, all these decisions require information. So we need relevant financial information for decision making. It says good management accounting information will provide information about these options, A or B, X or Y, L or M, and motivate the manager to choose the best option in the interest of the whole organization. So there is a specific area you will discuss or study somewhere in the future called marginal analysis, in which we make a decision about a certain option. We take the cost of the decision and the benefit, and then we decide should we or should we not. So very useful tool. Management accounting is a very useful tool available to management for decision making purpose. Like these decisions. Should we change our selling price? If we do, should it go up? Means should we increase our price or should we reduce? If the customer demand is affected, what will happen to our profit? See? So you can't just make a decision in isolation. You need to see if you increase your price, it will eventually cause decrease in quantity demanded, so it will affect your revenues and profits. So decision has to be taken by considering the factors regarding the elasticity of demand. What if the price changes and the elastic demand is greater than 1 year? Consumers may stop buying or will reduce the quantity purchased. Right? So these are decisions which management accounting will help us take. Should we invest in modern machinery? If we do, will it increase our cost or will it decrease? That's where management accounting comes in, and it will provide us with the relevant information we need to take such important business decisions. Another important example, what will happen if we change our supplier? What would happen if we change to a more reliable but more expensive supplier? So you need to see the cost of this decision versus the expected benefit. That's how we make decisions. How many units of output do we need to sell to break even? Break even is that level of output and sales where no profits are made. Your cost is equal to your revenue earned. So it's a point where there is basically no profit, no loss. And that is the basis of CVP analysis, connection between your cost, revenues, and profits. This is a break-even chart. We'll discuss it later in detail. This is a very useful tool. From this break-even chart, we can see the effect of changes in your selling price, which will affect your revenue, changes in your variable cost, changes in the fixed cost. So, changing these variables, how will it affect our profitability? What will be the effect of increase or decrease in selling price? What will be the effect of increase or decrease in the fixed cost or the variable cost? How would increase in the volume of our sales affect our profitability? So this is a very important tool management uses to make decisions about CVP. Will our break-even point be affected if we adopt the policies being considered above, increase or decrease our price, or effect on the selling price, variable fixed cost? All this is studied in CVP analysis. So this process of looking at the relationship between changes in activity, output, and changes in costs and revenues. So the changing parameters of profitability, cost, volume, and profit, this is called cost, volume, profit analysis, or simply CVP. CVP specifically involves short-term decision making, which means we have to take some assumptions. I'm a little doubtful about realistic. We have to take some assumptions to make it work. Just like the law of demand works when there are certain assumptions, like everything else is the same. If the price goes up, the quantity demanded falls, and vice versa, right? So there are certain assumptions that will make this CVP model work. Otherwise, it will collapse and fail. These are some simplifying assumptions, not realistic. They can be challenged. Every assumption here can be challenged. Cost and revenue relationships are predictable and linear. It's an assumption, challengeable assumption. It may not always be true. Cost and revenue, they do not move in perfect lines, straight lines. The total variable cost changes proportionally with volume, which means if you increase your production level with 10%, your total variable cost will also go up by 10%. Changes in inventory are insignificant in amount. Fixed costs remain constant over the relevant range. Fixed cost doesn't change. Unit selling price and market conditions are all constant. Production equals sales. Whatever you produce is sold, and your revenue or sales mix stays the same. If you sell 3 products ABC and 50% of your total sale is A in quantity, 30% B, and 20% C, this mix called sales mix or revenue mix stays the same. All these assumptions are not realistic. They can be challenged, every single one of them. However, we have to assume these so that to make the model work, so as to make us use this model effectively. Assumptions of CVP. Variable cost per unit are assumed to be constant. Means, let's say, if we produce a certain item that takes these many variable, direct material, direct labor, variable overhead. These are the cost of production. It takes $2 of material, $3 of labor, and let's say $5 of variable overhead, like electricity at production facility, indirect material, indirect labor, which varies with production. So the total cost per unit is 10. So whether you produce 10 units or whether you produce 1 million units, per unit cost stays 10. Every unit you produce will cost you 2, 3, 5, 10, 10. This is called variable cost per unit, right? So variable cost per unit stays the same, but as you increase your size of production, as you produce more units, your total variable cost will go up. But variable cost per unit stays the same. This is a very important assumption. Next assumption, sales revenue per unit is assumed to be constant. Per unit sale, let's say if the variable cost is 10 per unit, our selling price is 25. So whether you sell 1 unit or 1 million units, each unit sells for 25. So Sales revenue per unit is the same, but the total revenue, of course, would increase if you sell more units. If you produce and sell more units, clearly, you will get a higher revenue. Next assumption is that the company is operating within the relevant range. Relevant range is a boundary. Maybe it is because of the contract with your workers or the production capacity of your machine, a specific range of production from 0 to 10,000 units. This is the specific range. Within this relevant range, within this boundary, two things will be observed. Your total fixed cost stays the same, and your variable cost per unit stays the same. See here, relevant range defines the limit within which per unit variable cost remains constant and fixed cost in total remain same. And it is also called short run, or is synonymous with short run. So within this relevant range, you will observe two things. Your cost per unit stays the same, 10 per unit, whether you produce 1 or you produce million, and your, of course, total variable cost goes up, and your fixed cost in total stays the same. Your fixed cost, whether you produce 1 unit or you produce 10,000 units, your fixed cost stays the same. And this is it. Your total fixed cost stays the same, and coming previous, your variable cost per unit remains constant. And this happens within the relevant range. Alright, let's consider this example. A manufactured product has a unit sales price of 0.60 and unit variable cost is 0.20, fixed cost is $10,000. So if you take your unit selling price and your unit variable cost, this 0.40, 0.60 unit selling price, 0.20 unit variable cost, the difference 0.40 is called the unit contribution margin. This is what each unit contributes to cover the fixed cost. Okay, let us plot this on a break-even chart. On x-axis we have a number of units. On y-axis we have two things, our revenue and our cost, sales and cost. Alright, let's go. Let us plot first our fixed cost. Our fixed cost stays the same whether we produce nothing or whether we produce 30,000 within the relevant. Let's say 30,000 is our relevant range. So fixed cost stays the same. Next, our variable cost is 0.2 per unit. So if we produce nothing, variable cost is 0. If we produce 1,000 multiplied by 0.2, variable cost will be 200. When we produce 10,000, variable cost will be 10,000 to 0.2, 2,000. So if you plot these points, so this will give you the variable cost line. Right. We know total cost is sum of total fixed cost plus total variable cost. So if you combine these two, the net result you get is the total cost. So you can see this total cost is the combination of these two curves, or lines I would say, straight line, fixed cost and variable cost, right? Now bring in the last determinant of break-even chart, revenue. Each unit I sell gets me 0.6. I sell 10 units, I get $6. I sell 100 units, I get $60. I sell 1,000 units, I get $600. I sell 10,000 units, I get 10,000 times 0.6, $6,000, which means the revenue line would be steeper because it is 0.60 per unit. Remember, this is your variable cost, which is $0.20 per unit, is flatter. But revenue line is steeper because it's 0.60 per unit. So when you construct the revenue line, here it is, it's steeper than the variable cost. So this is basically $0.60 per unit. Right? Now, important conclusion to be drawn. This region you see to the left of the screen is the region when our total cost is more than total revenue. So when cost is more than revenue, this is the region of loss, and that's what we have here. This is the region where we have loss. Between 0 to 25,000 units, we are incurring losses. Beyond this point, this region, you see, total revenue is greater than total cost, so this region offers profit. So we have losses in this region, profit in this region. And this point here specifically where total revenue and total cost line cross each other, this is called the break-even point. And this is the point where we make no profit, no loss. So 25,000 units is the level of output and sales where there is no profit, no loss. Now we are in a state of pickle. Do I have to construct break-even chart every time I would like to determine my break-even point, the level of output when there is no profit, no loss? The answer is no. You have a very helpful formula that will help you identify your break-even quantity. Simply take your fixed cost and divide it with the unit contribution margin. Fixed cost is $10,000 and each unit contributes 0.40. And what is contribution? Please remember, unit selling price minus unit variable cost. 0.40 is the unit contribution margin. So 10,000 upon 0.40 gives you 25,000 units. So without this diagram or graph, we can derive break-even quantity. We can find break-even quantity, the level of output where there is no profit, no loss. So this is a very handy formula. Break-even quantity is equal to fixed cost upon unit contribution margin. Okay, so if this is the break-even quantity, when you sell 25,000 units, you make no profit, no loss. Fine. What if I want to find the break-even sales revenue? Can I do that? Yes, absolutely. Break-even sales revenue is the quantity to break-even times the selling price. So I need to sell 25,000 units to break-even, and each unit sells for 0.60. So 25,000 times 0.6 gives me $15,000. Does our graph support this number? Yes, it does. Look at this. At this point, our revenue is $15,000. And this point, cost is also 15,000. That's why it's a break-even point, because cost and profit, cost and revenue are both the same. Total revenue is equal to total cost. So this is break-even revenue, $15,000. This is break-even quantity, 25,000 units. All right, so it says break-even analysis can be used to determine a company's break-even point. We just saw that graphically. Break-even point is a level of activity at which the total revenue equals total cost. At this level, the company makes no profit. We already know that. With reference to the break-even point, the managers can set their sales goals and profit targets by changing variables: sales, variable cost, fixed cost, selling price. So this is it. This is the cost composition. This is your relevant range, Q2 to Q3. Within this range, you see the total fixed cost stays the same, but below this point, total fixed cost falls. Consider this the rent of your production facility. So if you produce between this range, this is the level of rent. If you increase the level of production from Q1 to Q2, rent goes up. You need to take in more space. And as you keep on expanding the production facility, you need to step up the cost. This cost also called the step fixed cost. So, but within this specific range, your total fixed cost stays the same. Then within this next range, the total fixed cost stays the same. And this is applicable to the next layers as well. We have discussed this idea of relevant range, fixed cost in total staying the same and variable cost per unit staying the same. And within this relevant range, you have this break-even point. We have discussed a much better break-even chart than this one. So break-even point or break-even quantity can be calculated using this formula: fixed cost upon contribution per unit, already discussed. And sales units required for a desired profit, that's an addition to the formula. We just learned that break-even quantity is equal to fixed cost upon unit contribution margin. Let's say I don't just want to cover my fixed cost. I need to earn some profit. So this formula needs little revision. In this case, we will say target unit sales, or just unit sales, is equal to, I need to cover the fixed cost, and I also need a certain operating profit, desired operating profit. I will call it target operating profit upon unit contribution margin or contribution per unit. So this is the formula, which is just a little revision of break-even quantity. So you replace break-even quantity with unit sales. The output will be the units produced and sold. But this time we need to cover the fixed cost as well as some target operating profit. And rest of these two things are exactly the same as in the formula: fixed cost upon UCM, but the addition is of this target operating income. One important concept that you need to learn: let's say I budget to sell 30,000. I plan to produce and sell 30,000 units. This is going to be my total revenue and total cost at this level of production and sales, right? My break-even quantity is 25. This cushion, this buffer I have between the budgeted quantity and the break-even quantity, this is called the margin of safety. This is the comfort zone I have. I can plan anything between this. If the units fall below 25,000, there will be losses, but between 25 to 30,000, I have profits available. So this is called margin of safety. I'm safe within this limit, but below this limit, there will be losses. And above this limit, of course, you have much more profit available, but this is the cushion you have. This is called margin of safety. So margin of safety is budgeted or actual sales. Let's, in our example, 30,000 units minus break-even sales, that is 25,000 units. So it can be expressed in units. And if you want the margin of safety to be expressed in a dollar, then simply multiply the margin of safety with the unit selling price. In our example, it was 0.6. So in this case, the margin of safety would be 3,000. Let me show you how it looks there. So this is the margin of safety in quantity, 5,000 units. And this gap here, this and this, 18,000 clearly. So this gap between 15 and 18, this is the margin of safety in dollars, and this is the margin of safety in units. And this brings us to the end of this subunit.